Force majeure. In peacetime, it's a dry clause buried in a contract, a textbook term. But this morning, on March 9th, 2026, those two words broadcast a very different signal. A 90-year-old institution, Bapco Energies in Bahrain, has just declared it to all clients. All operations have stopped. In the cold arithmetic of global energy flows, this means something far simpler. We have been hit. We are down. This is not a glitch. It is confirmation that a critical node in the system has been severed. But this legal notice, it's only the signal. The real question is, what is the fire? The fire is on the Manama skyline, a pillar of flame and smoke visible from highways across the island, rising over the wail of refinery alarms and sirens. For hours it burns, turning the night sky orange. On the residential streets below, a black rain begins to fall, dotting cars and balconies with a sticky film that smells of burnt crude. This is how a broken choke point looks when the math finally hits the pavement. Accidents do not fly in formation. This was a coordinated strike by Iranian-made Shahed series drones. They came in low, slipped under Bahrain's air defense picture, and detonated where they were meant to. When low-cost Shaheds cross that radar envelope, it is not just Bahrain's grid that fails. The same architecture rings refineries and shipping lanes up and down the Gulf. The assumption that US-aligned defenses could cordon off core energy assets is now gone. They hit the nation's sole refinery, the Bapco complex, fresh from a $7.3 billion modernization program. Its expanded capacity is roughly 400,000 barrels per day, a volume already written into regional supply and pricing chains. Take that offline and every barrel tied to Manama has to be rerouted, imported, or repriced. The message to every capital watching is simple. This strike package can paralyze critical energy infrastructure on demand. We saw this playbook in 2019 when the Kuwait strike knocked out 5.7 million barrels per day, about half of Saudi output. And within hours, prices and risk premia snapped higher from that single point of failure. That was the proof of concept. This strike is the scaled execution. But the inferno itself is not the real event. It is only the trigger, the physical entry point to the true target. The global price of energy, which is now a weapon. That weapon was fired almost immediately. The Bapco force majeure declaration was not an endpoint. It was a signal. Following Bapco's lead, Qatar Energy declared force majeure on its LNG shipments. Then, Kuwait suspended its own exports. Seeing the pattern, Saudi Aramco didn't wait to be hit. It preemptively shut down its key refinery at Ras Tanura. On a shipping map, export routes blinked out in sequence. Bahrain's crude lanes, Qatar's gas routes, Kuwait's tankers, then Ras Tanura on Saudi's east coast, going dark one by one. In less than a week, that cluster of terminals took a critical slice of Gulf export capacity offline. To the market, it was a visible fracture in the spine of seaborne energy leaving the region. The market's reaction wasn't fear, it was arithmetic. Remove a large block of Gulf supply overnight, and the clearing price for what remains has to reset higher. Higher Brent feeds straight into refiners' costs, airlines' fuel bills, manufacturers' margins, and those hits to future earnings force equity valuations lower. Within just 10 days, Brent Crude spiked to an intraday high of $190.50 a barrel, a rise of over 60% from pre-conflict levels. Energy names buckled first, then broader indices followed as risk models recalculated. Credit spreads pushed wider, funding costs jumped, and volatility spilled across currencies tied to energy imports.
Here's the arithmetic that completes the picture. $6 trillion erased from global equity markets. In New York, the Dow Jones Industrial Average plunged over 800 points intraday. In Tokyo, Japan's Nikkei index fell by 7%. Screens from London to Singapore showed the same pattern. Red across sectors, value vaporized. This was no longer a regional conflict confined to satellite images of a burning refinery. It had become a coordinated repricing of currencies, credit and trade flows around a single choke point, the Gulf. But a collapse of this speed and precision doesn't just happen. In normal crises, shocks take days to move from producers to prices to global indices. Here, 4 producers moved almost in lockstep with a preemptive shutdown at Ras Tanura that amplified the shock. The timing lined up too neatly with market hours to treat as coincidence. This wasn't chaos. This was architecture. And it forces the real question. Who was the architect? The trigger was a single event, markets treated as noise. Bahrain, the first Gulf state to join the US-led campaign, launched missiles into Iran. On news wires, it ran as a symbolic show of solidarity. In Tehran, that symbolic strike quietly marked Bahrain as a target for retaliation. The figure turning that headline into economic war isn't a ministry or a general, but a single man who directs the IRGC and Iran's oil flows. In Tehran, the son of the man the Americans killed, Mojtaba Khamenei, Iran's supreme leader, sits in a control room, eyes moving between Gulf maps and price screens as he issues measured instructions over the chaos. For him, this is not geopolitics, but calculated personal revenge for his father's killing carried out through the one instrument he knows Washington cannot ignore, the price of oil. He is not asking for a ceasefire. His camp has spelled out the condition. An IRGC spokesman: if you can tolerate oil above $200, continue this game. That is not flourish, but a target. With oil at $1.9, that spread is the clock he is watching. This is the deliberate weaponization of energy. A strategy built to force Western budgets to absorb punishing import bills, drive another inflation wave, and fracture already fragile political coalitions. In response, the G7 have called an emergency meeting to stabilize global energy markets. Their plan rests on a comforting assumption about that gap, and as we'll see, on ignoring the basic arithmetic of moving from $119 toward $200. That arithmetic was brutal in its simplicity. In a televised address, G7 leaders announced what they framed as overwhelming force: a coordinated release of 400 million barrels of oil from strategic reserves that held a little over 1.2 billion in total. A firewall, they called it, meant to break the fever in the markets and restore order. For a moment, it sounded decisive. The headlines talked about stability, not panic. The architects of this crisis were betting on something colder. The global economy burns around 100 million barrels of oil a day. On that scale, 400 million barrels are not a fix. They're a buffer worth barely 10 to 12 days. Picture a single fuel gauge for the planet. The needle stepping lower each day. 11, 10, 9, while nothing on the ground changes. On day 0, the tank is empty. The release creates no new supply. It just papers over the deficit while the refinery in Bahrain is still a ruin and the Strait of Hormuz remains a choke point. Inside the alliance, they were staring at the same math. 10 to 12 days, then nothing. The first signal that this strategy had failed didn't come from a market crash. It came from an ally. Japan, dependent on imported energy, broke ranks and announced it would tap its own national reserves independently. In that decision, Tokyo told the world the G7 firewall was a stopgap, not a shield,
and markets read it as the first visible crack in the united response. This wasn't just a policy error, it was the first fracture in a 50-year assumption that in a crisis the system could always produce or procure more. Since the 1973 oil shock, we've treated supply as a financial problem, not a physical one. What happens when the barrels are simply not there? When the foundational promise of global trade, that what you need can always be shipped, finally breaks? It's a question the world hasn't had to seriously ask since 1973, and we are about to find out the answer. The answer arrives not as a single event, but as a rapid, brutal cascade. The drone slipping across the Gulf. The impact flash over Bapco. Mojtaba Khamenei's face filling the screen. Force majeure from Bapco, then Qatar, then Kuwait. Stock tickers plunging in London and New York. The G7 emergency meeting collapsing into failure. The fuel gauge on the world's economy draining day by day. For 50 years, the working assumption of the global economy has been simple. Gulf crude will keep crossing the Strait of Hormuz, reliably and predictably. Here is the arithmetic that changes the picture. Bapco, Qatar, and Kuwait go to force majeure. Flows stall. The world starts eating into its last 10 days of reserves while a patient adversary leans toward $200 oil. That isn't volatility. That is the moment the continuity assumption dies in real time. And right now, the fire at the Bapco refinery in Bahrain keeps burning. A column of flame punching into the night, storage tanks washed in flickering orange against the black Gulf. The world now sits on a razor's edge. 10 days of reserves, one more shock away from outright shortages. Push crude towards $200 and you're in stagflation. Prices rising while growth stalls. The regime that quietly reprices every cheap energy portfolio. In the next chapter, I'll map that stagflation chain into positioning. The 50-year energy assumption is gone. With only that thin buffer left, what's the next domino you're watching? Let me know in the comments. That is the anatomy of the crisis. Now, what does it mean for your portfolio for the next decade? The oil spike is painful, but the lasting risk is the regime it can lock in. Stagflation, a period where sustained high energy costs feed inflation, while growth and margins are squeezed. Through much of the 1970s, inflation stayed elevated for years as central banks repeatedly hiked rates, and both equities and bonds delivered weak real returns. That structure leaves policymakers with bad options. Tighten to contain inflation, and you raise the risk of a deeper recession. Stay too loose to support growth, and you risk embedding high inflation and forcing harsher tightening later. Today, a persistent supply choke point like a disrupted Strait of Hormuz, paired with CPI data that keeps surprising to the upside, is the signal that we are moving into that regime. For investors, this is where the usual logic of diversification breaks. In stagflation, both sides of a standard 60-40 can come under pressure as rising inflation and policy rates drive up real yields, compress equity valuations, and push down nominal bond prices. Most current allocations were built for the last decade's assumptions: low and stable inflation, falling rates, and heavy reliance on growth equities and nominal bonds for both return and protection. When Hormuz disruption persists, inflation prints run above expectations, and both stocks and nominal bonds struggle together. A fundamental reallocation is no longer optional. The direction is toward assets with explicit or implicit inflation linkage. Real assets, commodities and gold, and instruments like TIPS and other inflation-linked bonds. Handled passively, that shift is a portfolio nightmare.
Cash and fixed coupons lose purchasing power, growth names are repriced on higher discount rates, and the old bond hedge weakens. A smaller group, tracking these choke points in real time, will see something else. A hidden edge, as value and pricing power concentrate in a new set of assets and routes. That edge is what we map next. But the narrative of a uniform global economic meltdown is dangerously simplistic. For investors anchored in North America, the key insight is that the same geopolitical shock that cripples import-dependent nations can create a relative advantage. Here is the arithmetic that changes the picture. As a simple mental model, imagine a region that must import well over half of the energy it burns, largely via sea lanes and choke points such as the Strait of Hormuz. Now, compare that to North America, where a much larger share of demand is met by domestic reserves and shale output, reinforced by integrated pipelines, storage, and the Strategic Petroleum Reserve, with imports as a supplement rather than the core. Both systems still trade on global prices, but the second is more self-reliant. When Gulf supply is weaponized and benchmarks spike, import-dependent economies take the hit twice. Higher input costs and the risk that barrels never arrive, forcing shutdowns. North America still pays the higher price, but its domestic reserves, shale production, and strategic stocks allow more industry to keep operating with fewer physical disruptions. So the practical move now is to map your capital onto this energy geography. How much of your portfolio is tied to economies and sectors that live or die on imported energy and long sea lanes? And how much is anchored in North American energy infrastructure that keeps moving molecules even when the Gulf goes dark? In a choke point shock, sustained higher benchmarks expand cash flows for North American producers whose volumes keep flowing. They also support midstream assets, pipelines and storage, whose fee-based contracts are tied to throughput and capacity rather than daily price swings. Keeping those systems utilized as domestic production is redirected to meet local demand and exports. Overweighting these producers and midstream is a precise positioning choice. It aligns your capital with the part of the system that gains relative strength from the shock that blindsides import-dependent competitors. This is not a new theory. It is the principle behind capital preservation in every major energy shock. Next, we will look at how a young Donald Trump moved through the 1970s oil shock SAR and what that playbook suggests for protecting your position now. This principle of resilience is not an abstraction. It's a live stress test we've already seen. What happens when a distant supply fracture rips through a leveraged balance sheet? To see it at human scale, we go back to 1990 and to one of the most recognizable businessmen on the planet. The year is 1990. Donald Trump's empire is a monument to leverage, stacked on billions in debt, with the $1 billion Trump Taj Mahal casino at its center. In August, Iraq invades Kuwait. Oil jumps from around $15 a barrel to over $40, helping push the United States into recession. Here's the chain. The oil spike raises costs, hits discretionary spending, commercial real estate, and casino revenues slump. And the cash flows feeding Trump's debt machine start to dry up. For an empire built on borrowed money, a recession is not just a slowdown. It's a sudden failure of revenue. Hotel bookings soften, casino floors thin out, and the income that services the debt isn't there. The Taj Mahal buckles. In 1991, it files for Chapter 11 bankruptcy with nearly $3 billion in debt. The media does what markets do to fallen heroes. It writes the obituary, turning him into a cautionary tale, his face under headlines about default and collapse. After personally guaranteeing hundreds of millions in loans, His net worth is not a clean zero. It's a negative number, reported as approaching $900 million. Imagine knowing that every asset you own and years of future work still leave you underwater. The same oil shock out of Kuwait has, through recession and revenue collapse, blown a 9-digit hole in one man's balance sheet. That is the arithmetic of ruin. But the story doesn't stop at that floor. He has two options: walk away and let the numbers bury him, or turn the wreckage into a negotiation. As he later put it, "The early 90s were very tough. I owed billions of dollars, but I fought back and never gave up." That shift from shock to problem solving is the first counter move. What follows is years of hard, methodical restructuring with more than 70 banks. That number means overlapping meetings and the risk that one refusal triggers a cascade of defaults. He trades time for control, asking lenders to stretch maturities, shift payment schedules, even swap debt for ownership, just to keep the system from snapping at once. In macro terms, he can't change the shock, only the structure. Preparation, for you, is mapping those creditors and cash flow dominoes before the hit, so resilience has something to work with. This story shows that preparation and resilience can turn even the worst crisis into a comeback. To get more frameworks that protect your edge, subscribe to the channel and click the bell.